Thanks very much, Vanchan. It's very clear, very detailed, and good work. We now have 4 people who will comment on the paper. They're all.
Please let me know if I should stop sharing or.
Yes, please. Yeah.
Okay.
So we now have 4 people who will comment on the paper, but also offer their thoughts more generally on developments in Chinese housing markets. So let me turn over first to Gyourko, who's a very well-known urban economist at Wharton. Over to you, Joe.
All right, thank you, Prakash. Thank you for having me. Really interesting paper. My comments are going to be fairly high level. As you saw from the presentation, the flow chart, there are a lot of moving parts and a lot of assumptions, and you could quibble with this, that, the other. I just don't find that all that useful because I basically believe the story. So here's what a couple of points that I thought were interesting summary statistics. Number one, there doesn't appear to be a decline in the very high real estate share in GDP since 2016. So it hasn't gone down. Number two, there was a point in the paper where they talked about the rise in per capita floor space for urban households, and it's gotten to 420 square feet. Now, it's 39 square meters, and so I converted since I'm an American, and that's up over a third since 2010, according to their numbers. That's a big change, and you're getting basically into developed country numbers when you get above 400 feet a person. So that's kind of interesting. And then third, I like the idea of focusing on tier 3 cities because we know from other work that Zipf's law doesn't hold in China, or at least doesn't hold as well as it does in other more advanced countries. So there's a lot more going on in smaller cities, and not all of these cities are small by any means, but than you'd expect. Using Zipf's law in the US or some other country like that. Okay, so this is an interesting idea. In terms of estimation errors, one of the things, just for reference, the per capita living space in equation 1, that they're multiplying by the number of urban households and the like, my gut is that's probably understated, which means they're not falsely claiming some huge supply in these tier 3 cities. At least my understanding from the Chinese data is that if I own 3 units, 2 of them are vacant and only 1 of them's occupied, my per capita living data only comes from the occupied unit. If so, we know there are these other units out there. Per capita is actually higher because there's a bunch of other units out there. Like you said, that works in their favor, but I think their estimate, the data they're using is probably biased down in that sense. Second point is what we have here is a measure of inventory. And I think I like the triangulation was let's do it 2 ways and see if we come up with a common measure, and they do. They get pretty close, which gives them confidence. All the assumptions are not wild. They're at least, if they're not all right, and we know not all of them are right, they're at least counterbalancing each other in similar ways. What's needed as we go forward is more emphasis on demand. I'm going to talk about the population numbers in a second, but we need to relate to vacancies, and we need to get demand more formally into the story. It's hard to talk about an imbalance when what you've done is a really clever and interesting analysis of supply, inventory, basically. So that's pretty interesting, I thought, but we need to work more towards incorporating demand formally into the analysis. That's not just them, that's all of us thinking about imbalance in the Chinese property markets. Okay. The other thing, which she mentioned at the end, and I'm glad that they're going to take this to individual Chinese cities is I suspect heterogeneity really matters in this. That, if you go to the Pearl River Delta, the smaller tier 3 cities, they're growing. They're not in trouble, and I suspect the imbalance will not be nearly as big as in what I think of as the Rust Belt, Heilong, Jiang, Jilin, Liaoning, and the like of China. And the reason I think that and encourage you to start going to individual cities and try to do this measure from the bottom up. I know there's no way you're going to get this data for 650 cities, but there's a long time ago, I'm really an old guy, 2 decades ago, Ed Glazier and I wrote a paper on urban decline and durable housing in America. And I'm working with a former graduate student on a study of urban decline in China. And we're working with about half the cities in their sample, but 330 or so prefecture level cities. So we're missing 300 of the non-prefecture level cities, but 20% of them appear to have significant population loss in the 2010s, 2010 to 2020, and it's regionally skewed. You see smaller tier, and these are tier 3 places. You see them, even in the South, but it's much more concentrated in the Northeast. And some of these declines are way bigger than you see in the U.S. So part of what we're going to study is why is decline where it's occurring appear to be more rapid in China. But if our data are right, what it says is that the problems you're going to get from the imbalance in those places could be very rapid and potentially very severe. But so exploit the heterogeneity even more. I understand tier 1, tier 2, and tier 3 is already heterogeneous, but within tier 3, I think there's going to be some really interesting comparisons to make. Couple of points then on their figure 3, and she mentioned it in a slide, there's an implied 20% price drop in tier 3 cities. And to me, I believe that. There's a lot of aggregation and disaggregation going on. But if you just look at the 70 cities index and the August data are out, the max decline for any of the 70 cities over the past 12 months of the lagging year is 8 to 9%. And that suggests in tier 3 cities, if you've got real population loss amidst this sort of some chaos in the property markets in China, I can easily imagine losses there. One way you may be able to see this is when you pick your individual cities that you're going to study and do detailed cases on, is to look at listings data for complexes in the city and scrape the web and do that. So that's, I think, an interesting way to go is, do you actually see falls in listing? Now it'll be listing, not transactions prices, but those listings data have been used by others. Other point is on the population decline, I just want to state, I absolutely believe that in aggregate, tier 3 cities are slightly declining. That's an average that's masking a lot of variation, just according to what we found out on prefecture level cities. Okay. The rise of the ratio of under construction units to completed units is really interesting. And the pattern, I think, is more systematic. It's different from the US. You saw the same change in the US, but it was related to supply chain snafus in America. In other words, during COVID, for a short period of time, there were a bunch of uncompleted units in US housing markets, but it's basically ended now. So one of the things to look to is, does it end in China? I suspect not, which means you probably got some real imbalance going on. Next point, construction sector debt levels, which she passed over for time constraints, they really are high compared to, say, the United States. For example, big home builders like Toll Brothers, Lennar in the U.S., their leverage ratio, their debt to equity ratio is below 1. And so their leverage ratios are well below 50% in comparison to the numbers they're presenting in the paper. So that's that's one of the reasons these developers are having problems. They are really highly levered. And the government obviously knew this. One of the 3 red lines was a debt to equity constraint that was imposed, and they were trying to get these folks to delever, but those are high numbers in any way. Last things I want to just touch on is just what do I think this means for Chinese housing markets and risk to the broader economy? Like I said, one, while I encourage more exploitation of heterogeneity, I believe the basic story. I have no quibble with that at all. Where do I think the stresses will come about? Partly it'll be, first stress will be, even in tier 3 cities, price to rent ratios are above 20, as best we can tell. That's kind of like a growth stock. And we all know from just looking at tech prices these days, small changes in expected trends can lead to big changes in valuation, simply because you're trading at a high in tech stock land price to earnings multiple and price to rent multiples, because rents are technically, the earnings of the building. So I think we're likely to see a lot of volatility as sentiment deteriorates in China. That's what I think the Evergrande threat is. It's going to have one of its biggest impacts. It's going to be on price volatility, because even tier 3 markets trade at high price to rent multiples. Other place we should all start looking is what does this mean for land finance? That's a really tricky issue, and we know these local government financing vehicles are pretty opaque, but if we're going to see volatility that leads people to expect downward pressure on price, which, yeah, that sounds reasonable, what does that mean for those vehicles? What's the risk there? And then the third is, what's going to go on with population in the short and medium term? And there, I think where you're going to see is substantial variation across China. You're going to see regional variation akin to what you see in the United States. And that's led to a lot of interesting political problems in America. And I see no reason why it wouldn't lead to something similar in China. So one, a really interesting analysis. It, I think, highlights a potential weak spot that we hadn't really thought hard about in terms of Chinese housing. And I think there'll be much more to do for all of us as we expand the demand side analysis and we exploit the variation even within these tier 3 cities. So with that, Prakash, I'll turn it back to you.